just feels more like the world that they know. It's the same questions then. Hey, how do we structure this? Oh, we've got the options, we've got the perp, we've got the swap, whatever it is. It's like, oh, okay, this is the same world that we're used to. Because before everything was a bit clunky and nothing was all bundled together. But the closer you bundle it, the more it becomes like the services that they know from every other investment bank. And what about this? The other thing that people talk a lot of, right now the market's getting very excited about stable coins because there's a shit ton of, the TAM is massive, as you said. It's almost infinite, right? The TAM of money is big. But real world assets, something that gets talked about a lot. What is really happening there, and who wants to move on it?
Hey guys, welcome to Everyday Finance. A break from the dramatic boom and bust cycles that occurred in 2017 and 2021 is being made by the current increase in Bitcoin, which is maintaining a firm position over $117,000 after reaching an all-time high of $122,838. The Bitcoin Flow Pulse, which monitors the amount of Bitcoin that is sent to exchanges, is one of the key indicators that reveals unusually low activity. In contrast to previous cycles in which exchange inflows soared before severe crashes, this indicates that substantial holders are not getting ready to liquidate their holdings yet. Despite the fact that this change indicates that the market is becoming more mature, traders are cautioned to keep an eye out for flow spikes, which may still indicate a pullback. The rally is kept alive by maintaining a price over $115,000. Price decrease below $111,000 may indicate a trend toward cooling.
Why is the hedge fund space so slow to take off in crypto? There's many of them, but nobody raises many assets. And it seems that you're saying, yes, a lot of the traditional funds are now coming in and deploying capital. Why has the hedge fund space itself not grown as much as you would have imagined?
You mean in AUM?
Yeah.
Yeah. So I kind of feel like we had the sort of the last downdraft in markets, and then that took out a lot of hedge funds. Then we didn't have everything that all the largest hedge funds needed. We had most of it, but not all. But for my comment, before. But then we went to this like crazy choppy market, right? Where it's kind of hard to trade. In the past year, it's been kind of tough. And so you've got Bitcoin ripping, but it's been hard to trade. So for example, systematic trend following strategies, whether in equities or crypto, haven't really performed. And when people think about crypto, they go, okay, well, do I want this like more narrow risk profile to give me some but not all of the Bitcoin return, or do I actually just want Bitcoin? And so what we found is people actually just want Bitcoin. And so we've got a Bitcoin yield product that's going to go into the marketplace, and we've had actually, arguably for the first time, a huge pipeline associated with that. And we can see that the evidence of that is in the crypto treasuries that are all doing some form of yield generation on their Bitcoin holdings. So I think my guess, Raoul, is that as we get more ETFs, more variety of ETFs and leverage ETFs and all sorts of different things, capital will begin to find its way into the space.
Yeah, I think so. Are you seeing a lot of our old friends of the traditional macro space, whoever's left, now fully coming into the space? I heard a great story the other day because I always benchmark everything is what would Nick Roditi do? And I was speaking to somebody who's very close with him, and he's trading Bitcoin like a crack addict, which I thought was really interesting. I don't know how old Nick is now, 80, and now trading Bitcoin. So are you seeing a lot of the macro guys now move into the space? Because that was the thesis that, Dan Moorhead was first, obviously, and then there was a whole bunch of us and Alan and stuff. And are you seeing a lot of that?
Well, just first, like a quick tribute to Nick, because I remember when I was a swap trader at JP Morgan, I met him for the first time, and I was like, oh,
like the most amazing guy.
That's him. Let's just say he was one of the first people that I met in the context of crypto. And, I'll leave it to you to talk about what he actually does in this space. But let's just say, he's a legend. And so if legends like that activated in the space, and they have for some time, I'd say a bunch of them, and we know who they are, I won't name them. There was a core group, and there was another group that just hasn't been doing it. and I don't quite know why. I think it was because in a world where macro funds were struggling, they were looking for like something else to generate return from. They had a bit of a strategy drift, and people traded crypto as kind of a side hustle or side hobby. Now it's become a core investment thesis of something that has enough liquidity. And you can demonstrate that you can get in and out of the market efficiently and store it and buy it and all the things that we talked about before efficiently. And I actually think both quant funds and macro funds will be scaling their allocation from now into the foreseeable.
And how do you provide liquidity? You know, because part of your old job and my old job was sourcing liquidity for funds who need to move money around. How's that done now? If somebody needs to come in and buy, you know, X $100 million worth of whatever, whether it's perps or straight spot or whatever, how's that done for these guys in this market?
Well, on the spot side, it's been done the same way we've been doing it this whole time. So notwithstanding the fact that you and I both came from principal risk trading backgrounds, and that's how we gave liquidity to clients by making prices and taking on risk. Since day one here, we've had an agency-only model. And so the way that we have accomplished that, because no one exchange has sufficient liquidity to do the billion today or a couple billion a day sort of thing, is to do the smart order routing. So we have a cluster of venues that we trust, and then we will route those orders and have a whole bunch of very, very sophisticated ways in which you can layer an order book. And I don't want to descend too far into detail, but that's the way in which we orchestrate huge buying and selling, programs. What I'm really excited about, Raoul, is actually on a forward-looking basis. We made the Deribit acquisition. I'm sure you want to talk about.
Yeah, I mean, because I remember pinging you a while ago saying, you guys should buy Deribit. And you're like, no comment. No, you didn't even say no comment. You just didn't respond. And then it comes out, I'm like, really? It was a brilliant move. Because for me, Deribit was so important for the space because it does most of the options. And it's like, it's too important not to be in big hands because, you need to run an option market very carefully. And I thought it was an inspired move. Even though options haven't been massive yet, I think they're going to be enormous.
I think they will be too. So we launched what we call Intex, our perp exchange, and that's gone from sort of no volumes to quite significant, daily volumes and market share. So 5 to 10% market share, and we've had lots of, double-digit billion days. But we're missing options. And so options was the thing, the last completion of what we needed to have the full package and platform. And there was really only one platform, with 80% market share, it was Deribit. And so now that we've got that, we're, doing a tech integration, and it'll close later in the year. I'm really super excited to be able to offer eventually clients a place to trade spot, perps, futures, options. Right? Now I can see your wheels turning. You've got all the building blocks for everything that you want to achieve in one spot. The other thing that Deribit helps us accelerate is we've been talking for a while, and so long as I've been here, we've been talking about international expansion. And that's been a little slower, I think, than Brian would want it to be. And this helps accelerate our footprint. So not only does it bring, $30 billion in open interest, and I think they did $1 trillion in volume last year, but it gives us an anchor in the UAE, an anchor outside. We've had it for a while, but like a big and scalable presence outside the US.
And how do you compete with the existing options that are out there? How does that work? Why should people go to Deribit versus, what the CME is doing or whatever?
I think the answer, we've learned that like liquidity begets liquidity. And so put a Coinbase wrapper on top of it to get that trusted brand, or the amplification of two trusted brands is probably the better way to say it. I think we'll bring much more capital into this space. So we can go more into like the construction, the contracts themselves, but that's probably beyond the scope of this conversation. So being able to do everything in one place, I think is awesome. And taking on other liquidity pools, you'll see the fight unfold.
I just don't understand how you've got the bandwidth to do all of these things and then integrate these things as well, whilst sprinting a marathon at the same time.
After a tremendous 56% increase in just 30 days, the price of Solana Sol experienced a collapse to $185. a total of $30 million in liquidations in overheated futures markets, where open interest hit $12 billion, resulted. In this 9.5% decline, the technical analysis continues to be positive despite the drop. Once again, a golden cross has formed between the 50-day and 200-day exponential moving averages, which was previously followed by a 700% surge. Rather than being a trend reversal, the sell-off appears to have been profit-taking, according to data from the blockchain. For as long as SOL remains above $180, it is possible that another leg higher will occur. There is support between $168 and $157 if it breaks.
By your face, you're like, yeah, that's right.
Yeah, there's some truth to that. I'm actually gonna take a couple weeks off. That's my clever plan. Take a little bit of rest. It's been a 5.5-year sprint without a break, but the time is also now. It is an incredible challenge, but actually just having had our on-site, we've identified the big rocks for next year, what the focus is. So it's going to be international expansion, it's going to be derivatives, and we're going to narrow the focus and make everyone keep building. And so the big thing that we're working towards is, now that we have all these different component parts, it's just making the seamless experience across them all. And that's going to take cross margining across all these different things, a central risk engine, central financing engine. Our portfolio margining already has 85 different pairs for hedge funds. So it's awesome, but it is actually a reasonable amount of hard work.
And what about on the asset management side? What are you working on there?
Well, that was my reference to the Bitcoin yield product. So that's coming up. We've got a dynamic fund. I think what's happened is that it's a small group of people. They're amazing. They have the best pedigrees, great systems. They've passed institutional due diligence for a while now, but as you said, assets haven't been flowing in yet. And the number one thing really has been regulatory clarity. And so with that sort of cloud parting in the US in particular, we've seen a lot of wealth platforms, we're seeing RA platforms, the same kind of or similar enthusiasm that we saw for the growth of ETFs is in part reflected in terms of wanting asset management product. So it's still a small-ish business, but I have great hope that it will scale. One of the things that was kind of cool is that we launched the Coin 50, which is an index. I've been wanting an index, and Brian's been wanting one for a number of years. And then not only did we launch the index, so the IP of it is from Coinbase Asset Management, but then we actually launched a perp contract, and so that'll bring some liquidity to the tail. But it's cool, again, going back to our former lives. If now you've got options, perps, spot, financing, cross product margin, indices of, you can customize anything, right? And then we haven't even talked about tokenization.
Yeah, that was my next question. We'll come on to that. But
crypto's matured a heck of a lot. But now I think the big picture answer to institutional capital is, can we get exactly what we want at the time? And if you have all those tools, you can construct the package, whether it's an actively managed package, it's a structured product, it's an index. But if you can give institutional capital a menu of options as opposed to just one, they're more likely to allocate capital.
Well, it just feels more like the world that they know. It's the same questions then. Hey, how do we structure this? Oh, we've got the options, we've got the perp, we've got the swap, whatever it is. It's like, oh, okay, this is the same world that we're used to. Because before, everything was a bit clunky and nothing was all bundled together. But the closer you bundle it, the more it becomes like the services that they know from every other investment bank. And what about this? The other thing that people talk a lot of, right now the market's getting very excited about stable coins because there's a shit ton of, the TAM is massive, as you said. It's almost infinite, right? The TAM of money is big. But real world assets, something that gets talked about a lot. What is really happening there, and who wants to move on it? What kind of players first? Because I know, Franklin have been doing some stuff. You guys have been doing some. People have been tinkering still at the edges, but it's not yet the big thing.
It is not yet the big thing. And I think, learning all the lessons that you and I learned early in our careers, I was listening to someone talk about, Hood's announcement about OpenAI and SpaceX and the complexity of not knowing how the contracts settle. I mean, you and I are old enough to remember like Procter and Gamble and the Bank of Korea and all the whole, early years of credit default swaps, and was it really a credit default or wasn't it? And how do we settle the contract and the two sides and all that stuff? And you can just see it playing out again in crypto if you don't give a lot of thought up front to exactly how these contracts settle. So coming back to the point, there's a long and very eclectic list of everyone that wants to tokenize stuff. I'll put it in I'm doing this for the first time, but there's the TradFi world, which I think is interested in technology, ease of use, the sort of end-to-end cost of maintaining assets and tracking them. And, we're not long that problem as an industry in crypto. We're not. So that's kind of more like the banking world's problem to solve. If you look at the asset management community, when they look at tokenization, I think they're mostly looking at avenues to distribute more funds. So if you can make, for example, U.S. funds, the tokenized version of it, available to Europe, for example, if you can, and it's a good thesis to have, but you can't make an illiquid asset magically liquid and perform perfectly, right?
No, that's why it's like real estate people who sell real estate want to tokenize it. The buyers don't really want it. There's a bit of a mismatch. Like all the private equity guys, they all want to tokenize their funds. I mean, Apollo's huge in this as their big thing. But I'm like, who's the buyer of tokenized funds? Because they're hoping it's going to be retail, which is the last buyer who hasn't bought PE yet. I'm like, the kind of returns that retail get, if you're going to buy a token, you're going to buy a crypto token that goes up a lot. You're not going to buy a 10% a year asset.
Well, I don't know. I might challenge you on that.
I don't think so. I just don't think young people give a shit about this stuff anymore.
Raoul Pal places a strong emphasis on taking a strategic approach to cryptocurrency, which includes concentrating on the accumulation of wealth over the long term, gaining a grasp of market cycles, and staying one step ahead of future trends. This mentality is reflected in the market as it develops in 2025. The strength of Bitcoin, the lack of sell pressure, and the increasing institutional maturity all point to the possibility that the rules are shifting. Additionally, it is possible that the downturn in Solana is more of a natural reset than a reversal, which presents possibilities for those who are thinking beyond the short-term volatility context.